Long before Wall Street ever existed, before Venice rose from the sea, before the Bank of England defined modern banking, the foundations of global finance were already being engineered elsewhere. Not in Europe, but in a city most modern investors rarely associate with financial innovation, Baghdad. Between the 8th and 13th centuries, a system emerged there so advanced. It quietly shaped the financial logic the world still follows today, that a financial system sophisticated enough to support trade across 3 continents. It wasn't just about caravans and spices. It was about contracts, credit instruments, partnership structures, and enforceable commercial law. Welcome to the Financial Historian, where money, power, and history collide. And nothing is ever as simple as it looks. This is the story of how the Islamic Golden Age reshaped the architecture of finance, and how its innovations still echo in modern banking, venture capital, and global trade. Because finance didn't begin in Renaissance Italy. It didn't suddenly appear in 17th century Amsterdam. It evolved over centuries. And one of its most critical chapters was written in Arabic. To understand this transformation, you have to step into the world of the 8th century. In 750 AD, the Abbasid Caliphate overthrew the Umayyads and established a new center of power. By 762, the city of Baghdad was founded along the Tigris River. Within decades, it became one of the largest cities on earth, a political capital, an intellectual hub, and a commercial magnet. Its location was not accidental. Baghdad sat at the crossroads of trade routes linking China, India, Central Asia, Africa, and the Mediterranean. Silk, spices, textiles, metals, paper, and precious goods flowed through its markets. And wherever trade expands beyond local borders, finance must evolve to keep pace. Merchants traveling from Andalusia to India could not rely on carrying sacks of gold across deserts and oceans. Theft was common, transport was slow, risk was high. A civilization spanning from Spain to Central Asia needed more than coinage. It needed systems of trust. The Islamic world of this period offered something rare for its time. Relative political continuity across vast territory, a shared commercial language in Arabic, and a standardized legal framework grounded in Sharia law. This legal infrastructure proved just as important as its armies. Because finance is not built on metal, it is built on enforceable promises. The gold dinar and silver dirham circulated widely across the Islamic world, providing monetary consistency. But coins alone cannot sustain continental trade. Contracts do. Islamic jurists developed detailed commercial law governing partnerships, debt, trade, and dispute resolution. Merchants could enter agreements knowing that courts from Cairo to Damascus to Baghdad would recognize and enforce similar legal principles. When law becomes portable, commerce becomes scalable. One of the most important financial innovations of this era was the mudaraba partnership. The structure was elegantly simple. One party provided capital, the other provided labor and expertise. Profits were shared according to a pre-agreed ratio. Losses were borne by the capital provider unless negligence could be proven. This was not feudal tribute. It was structured risk sharing. The capital owner did not demand fixed interest regardless of outcome. Instead, he participated in upside and absorbed downside. The entrepreneur did not risk personal capital, but invested effort and skill. Both had incentives aligned with performance. If this sounds familiar, it should. The mudaraba resembles modern venture capital and limited partnership agreements. Investors fund a project, managers operate it, profits are divided by contract. Losses fall primarily on capital. That framework mobilized idle wealth. Instead of hoarding gold, investors could deploy it into trade expeditions, manufacturing, agriculture, and maritime ventures. Capital circulated, productivity increased, opportunity expanded. Constraint can force creativity. Under Islamic law, the charging of riba, often interpreted as usurious interest, was prohibited. Instead of fixed interest lending, financial relationships had to be structured around asset backing and shared risk. Critics sometimes portray this as restrictive. In reality, it drove innovation. If you cannot rely on simple interest payments, You design more sophisticated contractual arrangements. Trade finance replaced passive lending. Profit participation replaced guaranteed return. Finance did not disappear. It adapted. Meanwhile, merchants needed ways to move money safely across vast distances. Enter the SAC, the precursor to the modern check. A merchant in Baghdad could deposit funds with a trusted financial intermediary and receive a written instrument authorizing withdrawal in another city. Instead of carrying gold, he carried paper backed by reputation and enforceable agreement. The Arabic word sakk would eventually evolve into the English word check. This was not symbolic money detached from reality. It was trust codified in writing. The ability to transfer funds without physically transporting coin dramatically increased the velocity of commerce. Risk of theft declined. Capital flowed faster. Trade networks expanded. Alongside the SAC, the hawala system emerged as an informal value transfer network. Hawala brokers bound by trust and reputation could settle obligations between distant parties without direct currency exchange. Money moved through ledger adjustments rather than caravans. Critics sometimes misunderstand hawala as primitive. In truth, it demonstrates an advanced understanding of settlement systems. It relied on social capital, contractual enforcement, and reputational risk, components essential to any financial system. Finance scales when trust scales, and trust requires law. Islamic commercial courts enforce contracts across vast geography. Disputes were adjudicated, agreements were documented, property rights were recognized. Merchants did not operate in legal chaos. They operated within a system that recognized commercial obligations as serious matters of public order. Contrast this with much of early medieval Europe, where feudal fragmentation created inconsistent enforcement. Local lords controlled territory. Legal norms varied. Merchant risk was amplified by political instability. Transaction costs were higher. Trade networks were thinner. The Islamic world's unified commercial jurisprudence lowered those costs. Lower transaction costs encourage trade. Trade increases wealth. Wealth amplifies power. By the 10th century, Baghdad was one of the most populous cities in the world. Its markets were vibrant. Its scholars translated Greek philosophy, Indian mathematics, and Persian science. Intellectual flourishing accompanied economic expansion. But prosperity was not accidental. It rested on financial architecture. Another innovation worth understanding was the WAF, a charitable endowment structure designed to preserve assets for public benefit. Wealth could be placed into a legal trust to fund schools, hospitals, mosques, and infrastructure in perpetuity. The structure separated asset ownership from operational control, ensuring continuity across generations. Modern foundations and trust funds operate on similar principles. Wealth is structured for long-term stability rather than short-term consumption. This is where the story becomes larger than instruments. The Islamic Golden Age did not merely invent financial tools. It embedded them in a moral and legal worldview. Contracts were sacred. Reputation mattered. Enforcement was institutionalized. Financial relationships were constrained by ethical considerations. Every financial system encodes values. Some emphasize leverage. Some emphasize speculation. Others emphasize asset backing and shared risk. The Islamic financial framework prioritized partnership and tangible assets. Speculative excess was discouraged by design. Profit required participation in real economic activity. When finance is tethered to trade and production, economic bubbles are harder to inflate. That does not eliminate risk. It reshapes it. By the 11th and 12th centuries, these innovations have become normalized across the Islamic world. Merchants from North Africa to Persia operated within shared commercial expectations. Capital crossed borders more easily than in many other regions of the world. And here is where the narrative shifts. Finance does not remain isolated. It travels. Trade routes linking the Islamic world to Europe became conduits for ideas as well as goods. Mediterranean commerce intensified. Italian city-states like Venice, Genoa, and Florence interacted extensively with Muslim merchants. Partnership structures credit instruments, and commercial practices crossed cultural boundaries. They were adapted, modified, and integrated into European systems. Modern finance did not spring from a vacuum. It evolved through transmission. But prosperity is never permanent. In 1258, the Mongols sacked Baghdad. The city was devastated. Political fragmentation intensified. Trade routes shifted. Power dynamics changed. Over the following centuries, European maritime expansion altered global commercial geography. Yet, the financial innovations of the Islamic Golden Age did not vanish. They had already diffused. The story of modern banking, venture capital, and international trade credit includes chapters written in Arabic centuries before London became a financial center. Understanding this isn't about rewriting pride. It's about recognizing structure. The Islamic Golden Age demonstrates a core truth of economic history. When legal institutions support enforceable contracts, when financial instruments reduce risk, and when credit is structured to align incentives, commerce flourishes. Finance is not merely about money. It is about architecture, the invisible framework that governs how value moves. By the time Baghdad fell in 1258, the financial grammar of the Islamic Golden Age had already traveled far beyond its political borders. Instruments evolve, empires rise and fall, but architecture leaves fingerprints. And the architecture built between the 8th and 13th centuries did not disappear. It was absorbed, adapted, and in some cases quietly renamed. As European trade expanded in the late medieval period, Italian city-states began refining partnership structures that strongly resembled the earlier mudaraba. The command contract in Venice allowed one partner to provide capital while another conducted trade voyages, sharing profits according to prearranged terms. Sound familiar? It should. Risk sharing, limited liability, capital mobilization. The backbone of modern venture finance was already in motion centuries earlier. Meanwhile, bills of exchange became common across Mediterranean commerce. These instruments allowed merchants to settle debts across borders without physically transporting bullion, reducing risk and accelerating trade. The mechanics were increasingly sophisticated, but the principle remained the same. Trust formalized through contract. Finance travels with trade, and trade carries ideas. But something subtle shifted as European finance matured. While Islamic commercial law discouraged fixed interest lending and emphasized profit sharing tied to real economic activity, European banking increasingly embraced interest-bearing debt as its dominant structure. Over time, leverage became central to financial expansion. Lending at interest was not merely permitted. It became foundational. This divergence matters. Debt-based systems scale rapidly. Interest payments create predictable cash flows. Governments can borrow against future taxation. Banks' clear's throat can expand credit aggressively during periods of optimism. The system can grow fast, but leverage cuts both ways. When credit expands too quickly, economic bubbles form. Asset prices inflate beyond underlying productivity. When confidence falters, contraction is violent. The global financial crisis of 2008 was not caused by medieval trade disputes. It was fueled by debt structures layered upon debt structures, detached from real asset performance. Nothing says a stable system like needing one banker to rescue the entire economy. In 2008, major Western financial institutions teetered on collapse. Governments intervened with trillions in liquidity. Central banks expanded balance sheets dramatically. Interest rates dropped to near zero. Quantitative easing became policy language. Meanwhile, the modern Islamic finance sector, though smaller in scale, had certain built-in constraints. Sharia-compliant financial products require asset backing. Purely speculative derivatives are restricted. Interest is replaced with profit and loss sharing or fee-based arrangements tied to tangible assets. Islamic finance today represents over $2 trillion in global assets with major hubs in Malaysia, Saudi Arabia, the United Arab Emirates, and beyond. Sakk, often described as Islamic bonds, are structured differently from conventional bonds. Instead of paying interest, They provide returns linked to ownership stakes in assets or projects. This does not make Islamic finance immune to risk. No system is, but it illustrates something crucial. Financial architecture reflects philosophical choices. Debt-heavy systems prioritize leverage and rapid capital expansion. Risk-sharing systems prioritize alignment between investor and entrepreneur. Each is trade-offs. Each encodes values about responsibility, obligation, and participation. The Islamic Golden Age embedded finance within a moral legal framework emphasizing contract enforcement, shared risk, and asset grounding. When those institutions were strong, commerce flourished. When political authority fractured, economic dominance faded. That pattern is not ancient history. It is structural law. Strong institutions lower transaction costs. Lower transaction costs increase trade. Trade increases wealth. Wealth amplifies geopolitical power. But institutions require maintenance. Trust requires continuity. The Mongol invasion in 1258 did not just destroy buildings in Baghdad. It disrupted networks. It fractured enforcement mechanisms. It shattered centralized authority. Finance cannot operate in institutional vacuum. As European maritime powers rose in the 15th and 16th centuries, they brought with them adaptive financial tools and increasingly aggressive debt-based models. Colonial expansion was financed by joint stock companies and sovereign borrowing. Risk was socialized, profit was privatized, the architecture had shifted, and yet the DNA of earlier systems remained embedded in contracts, partnership models, and trust law. Fast forward to today. We live in a global financial system deeply dependent on credit expansion. Governments carry high sovereign debt. Corporations leverage balance sheets. Consumers finance homes, education, and consumption through loans. Inflation surges when demand outruns supply. Contraction follows when credit tightens. Financial education often focuses on surface indicators, interest rates, stock indices, inflation prints. But underneath those metrics lies architecture. How is credit created? Who bears risk? Who absorbs losses? How enforceable are contracts? How stable are institutions? These questions determine prosperity in 10th century Baghdad. They determine resilience today. When we examine the Islamic Golden Age, we are not romanticizing the past. We are analyzing design principles. First principle, enforceable contract, law scales commerce. Second principle, reducing transaction risk accelerates capital flow. Third principle, financial systems reflect moral and institutional frameworks. Fourth principle, when trust weakens, finance weakens. The modern global crisis of 2008 was not merely a housing problem. It was a trust problem. Complex derivatives obscured risk. Leverage magnified exposure. When confidence collapsed, liquidity evaporated. Contrast that with systems where risk is shared explicitly between capital and labor, where returns depend on asset performance rather than fixed interest obligations. Volatility may still exist, but the distribution of shock differs. The Islamic Golden Age demonstrates that finance thrives when tied to real economic activity and supported by consistent legal enforcement. It also demonstrates that no financial architecture is self-sustaining without political stability. Empires rise on trade. Trade depends on finance. Finance depends on law. Law depends on power. Money and power are inseparable. When you study economic history through that lens, you stop asking which civilization invented banking first. You start asking which institutional frameworks sustain trust longest. For investors seeking real wealth and financial freedom, this is not academic trivia. It is strategic insight. If you understand that financial systems encode values, you recognize that policy changes are not neutral. Shifts in regulation, monetary frameworks, and legal enforcement reshape opportunity landscapes. When risk sharing increases, incentives shift. When leverage dominates, volatility increases. We often think modern finance is unprecedented in complexity. In some ways, it is. But the underlying questions are ancient. How do you move value safely across distance? How do you align capital and labor? How do you enforce contracts across diverse populations? How do you prevent concentration of power from destabilizing the system? The Islamic Golden Age answered these questions in ways that allowed commerce to flourish across 3 continents for centuries. Eventually, political fragmentation and shifting trade routes reduced its dominance. That does not negate its achievement. It underscores a final truth. Financial systems are not permanent. They evolve with power structures. Today's global financial system, dominated by Western institutions, dollar-dominated trade, and debt-centric expansion, may feel immutable. It is not. It is architecture built upon law, policy, and geopolitical influence. Just as earlier systems rewrote the rules of finance, modern shifts, digital currencies, decentralized finance, Sharia-compliant banking expansion, regulatory reform may rewrite them again. History does not hand out permanent blueprints. It hands out case studies. The Islamic Golden Age rewrote the rules of finance by embedding trade in enforceable contracts, structuring risk, sharing partnerships, and scaling trust across continents. Its innovations traveled, adapted, and shaped what we now call modern banking. Money did not create that power. The rules governing money did. And that is the principle that survives every empire. History doesn't repeat, but if you don't understand the architecture of finance, you will mistake structure for inevitability. Money was never the real source of power. The rules that govern money were. Empires rise and fall, but financial architecture leaves fingerprints that outlive them all. And if you don't understand that architecture, you won't just miss history, you will misunderstand the future.